Did you know that the most valuable pharmaceutical company in the world wasn't started by a modern scientist in a lab, but by a Civil War veteran who once sat in a Confederate prison camp? In 1876, a man named Colonel Eli Lilly, a pharmaceutical chemist and a Union Army veteran, decided to open a small laboratory in Indianapolis. He had only $1,400 worth of equipment and a burning desire to provide high-quality medicine at a time when snake oil salesmen were rampant. But here's the kicker: today, that same company is the first pharmaceutical giant in history to cross the trillion-dollar market cap threshold. If you had invested just $1,000 during their IPO, you'd be looking at a fortune that rivals the biggest tech winners. Today, we are deep diving into Eli Lilly and Company, ticker symbol Eli Lilly. We are going to trace its journey from the 19th century to its absolute dominance in the S&P 500 today. Colonel Lilly officially founded the company on May 10, 1876. His mission was simple: take what you find here and make it better and better. This mantra led to the company's first major breakthrough, pioneering the gelatin coating for pills and capsules, making them easier for patients to swallow. It sounds simple now, but in the 1880s, it was a revolution. By 1881, the company was officially incorporated, and management eventually passed to his son, Josiah K. Lilly. This wasn't just a family business, it was a research powerhouse in the making. They were the first to hire a full-time research scientist in 1886. But the transition from a local chemist to a global stock market titan took time. They didn't just jump onto the stock exchange immediately. It took nearly 75 years of private growth and scientific breakthroughs, including the mass production of penicillin and the development of the first commercially available insulin, before the public could get a piece of the action. After decades of cementing its legacy as the insulin king, Eli Lilly finally decided to tap into the public markets. Eli Lilly and Company officially went public on the New York Stock Exchange in 1952. This IPO date marked the beginning of its journey as a staple of American investment portfolios. At the time, the company was already a leader in antibiotics, but the 1950s and 60s saw them expand into veterinary medicine and even the cosmetics industry, though that last one wouldn't last forever. Now, let's talk about the big league, the S&P 500. For a company to be the backbone of a large economy like America, it has to be a member of this prestigious index. Eli Lilly officially joined the S&P 500 index in 1971. Unlike many volatile tech stocks or turnaround plays, Eli Lilly is what we call a legacy resident. Since joining in 1971, Eli Lilly has never left the S&P 500. It has remained a constant component for over 50 years. While other giants like General Electric or even Sears eventually fell out of favor and were removed, Lilly's relentless focus on R&D ensured it stayed relevant through the high inflation 70s, the dot-com bubble, and the Great Recession. During its early years in the index, Lilly was known for a diverse portfolio. In fact, in the same year they joined the S&P 500, they acquired the famous cosmetics brand Elizabeth Arden. While it was a profitable venture, they eventually sold it in 1987 to focus entirely on their core competency, life-saving medicine. This decision proved to be a masterstroke. By shedding non-core assets, they were able to double down on neuroscience, leading to the 1987 approval of a little drug you might have heard of called Prozac. Prozac didn't just change mental health, it changed Lilly's balance sheet forever, catapulting the stock into a new stratosphere within the S&P 500's weighting. To understand why Eli Lilly is a cornerstone of the S&P 500, you have to look at their blockbuster strategy. In the pharmaceutical world, a blockbuster is a drug that generates over $1 billion in annual revenue. In the 90s and 2000s, Lilly became a factory for these. They launched Humalog, the first insulin analog, and Zyprexa, which became one of the best-selling psychiatric medications in history. However, it wasn't always smooth sailing. In 2009, Eli Lilly faced a massive hurdle when it agreed to pay a $1.42 billion fine to settle investigations into the off-label marketing of Zyprexa. At the time, it was the largest criminal fine in US history. For many companies, this would have been a death knell. But Lilly's cash flow was so robust, and its pipeline so deep, that it absorbed the blow and kept moving. This resilience is why the stock is a favorite for institutional investors. They don't just react to the present, they invest for a decade out. Throughout the 2010s, while the market was obsessed with FANG stocks, Lilly was quietly perfecting the next generation of medicine. They were building the foundations for what we are seeing today, the obesity and diabetes revolution. By staying in the S&P 500 consistently since 1971, Lilly has provided a ballast for the index. When tech is down, healthcare often stays steady. But in the 2020s, Lilly stopped being just steady and started becoming a high-growth monster. We are currently witnessing one of the greatest runs in stock market history. The catalyst? Tirzepatide. Known by the brand names Mounjaro for diabetes and Zepbound for obesity. These aren't just drugs, they are cultural and economic phenomena. This shift has propelled Eli Lilly's market cap past $1 trillion in early 2026, making it more valuable than most of the tech companies that used to look down on big pharma. What makes this so impressive from a business perspective is the margin. The demand for these GLP-1 drugs is so high that Lilly is spending billions on new manufacturing plants just to keep up. As of 2026, the company is not just a participant in the S&P 500, it is a driver of the index's total return. But let's look at some of its impressive numbers. If you look at the fundamental moat that Warren Buffett always talks about, Lilly's moat is built of thousands of patents and a clinical trial process that costs an average of $4 billion per successful drug. That is a barrier to entry that almost no one can climb. Despite the massive valuation, analysts are still focused on the pipeline. They aren't just the weight loss company. They are pioneers in Alzheimer's treatment with drugs like Kisunla, which was approved recently to slow cognitive decline. This diversification is exactly why they have never been removed from the S&P 500. They don't rely on a single miracle, they have a system for creating miracles. From a small chemist shop in 1876 to a $1 trillion powerhouse in 2026, Eli Lilly's journey is a masterclass in long-term business strategy. They survived the Civil War, 2 World Wars, and the Great Depression. They went public in 1952, joined the S&P 500 in 1971, and have remained a pillar of their index for over half a century without ever being removed. For investors, Eli Lilly represents the perfect marriage of old-school stability and new-age growth. Whether it's the 1920s with insulin or the 2020s with Zepbound, the company has stayed true to Colonel Lilly's original vision: make it better and better. Looking ahead, Lilly is now integrating AI through massive partnerships, like their $1 billion deal with NVIDIA, to accelerate drug discovery. This means the next blockbuster might not take 10 years to develop, it might take 2. If you are looking for a stock that defines what S&P 500 stands for, look no further than the house that the Colonel built. Thank you so much for watching this deep dive into Eli Lilly. If you found this breakdown of LLY's history and its S&P 500 journey helpful, make sure to subscribe to the channel, like this video, and leave a comment below letting me know which stock we should cover next.